Okay, so last week we started looking at IAS 16 on PPE. Today we are going to continue, and also next week we will continue as well because it's supposed to be a 3 weeks class based on our plan. And what we did last week was to look at the definition of PPE first. And when we look at that definition, we saw that PPE is any tangible item that is held for use in the production or supply of goods or services, rentals to others, and for administrative purposes, and it must be held for more than 1 year. We analyze that definition and we make you understand that for any item to be PPE, it must be a tangible item and it must be held for use. We explained all of that last week. Then we move to recognition of PPE. For recognition, we said before you can record PPE in your books, you must meet two recognition criteria. The first is that it must be probable that future economic benefit associated with the asset will flow to the entity, and it must have a cost that can be measured reliably. Those are the two recognition criteria for PPE. And we said when you want to record PPE that meets those two criteria in your books, you simply debit that PPE and you credit bank. But if you had bought it on credit, you credit other payables. And if you have gotten it for free, you credit other income. And we said when you recognize it, then you will need to measure it. For measurement, there are two measurement bases. We have initial measurements. There are two measurement levels. We have initial measurements and we have subsequent measurements. For initial measurement, which is the measurement at the transaction dates, we said that you initially measure an item of PPE at costs. And we say cost comprises the purchase price plus import duties plus non-refundable purchase taxes less trade discount or rebates. Then we say you're going to add directly attributable costs of bringing the asset to its location and condition for it to be capable of operating in the manner that is intended by management or for it to be ready for use. Those are directly attributable costs. And these directly attributable costs, we said, includes initial delivery and handling costs, installation and assembly costs, professional fees, site preparation costs, wages and personnel that are incurred for construction and acquisition of that asset. And what? And testing costs. And we said less sales proceeds from sales of samples, right? These are directly attributable costs. And I made it clear that any other cost that is incurred after the asset is ready for use, those should be expensed. Okay? Now, beyond that, we also mentioned initial estimate of dismantling, removal, and restoring the site to its original condition. So that also should be capitalized. But we mentioned that this cost is a future cost. That what we capitalize is the present value of this cost. That is what is capitalized. Then we also mentioned borrowing costs that are attributable to the construction and acquisition of that asset. I placed emphasis on construction because for you to capitalize a borrowing cost, which is interest you pay to bank on money you borrow, it must be that you have borrowed that money to construct an asset. You see, the interest you are paying on that money during that period of construction, that interest is capitalized. After construction is completed, any interest you incur afterwards is expensed. We do not capitalize such. That is borrowing cost. And that was initial measurement. Then we went to subsequent costs. We said subsequent cost is okay, after you have acquired an asset, you will still be incurring some costs. And the standard says that you can capitalize the subsequent costs if they meet the two recognition criteria. That is, if they generate future economic benefits and if they have a cost that can be measured reliably, then you can capitalize them. And I made mention that these future economic benefits must be that additional cost or that subsequent cost creates itself. It must be a new benefit. Okay, so if you have an asset that ordinarily will produce 1,000 units, that subsequent cost must make the productive capacity increase to 1,002. That is the subsequent cost you capitalize. So before you can say it has created a new benefit, that subsequent cost must improve the productive capacity of the asset. It must also improve the useful life of the assets. Note those 2 points. Then we went on to subsequent measurements. Jen, money they refill. Then we went on to subsequent measurements. And for subsequent measurements, we said there are 2 bases for doing this. There are 2 models for determining subsequent measurement because subsequent measurement is the measurement at the end of the year. Is the measurement at the when? At the end of the year. And there are 2 formulas for doing this. There are 2 models. We have the cost model and we have the revaluation model. You see, the cost model is simply cost minus accumulated depreciation minus accumulated impairment losses. The revaluation model is fair value minus subsequent accumulated depreciation minus accumulated impairment losses. Those are the models. Those are the formula. We started with the cost model. I told you that cost model, which is cost minus accumulated depreciation minus accumulated impairment losses, will help you get your carrying amount. Its aim in life, both cost model and evaluation model, is to help you determine your carrying amount. And you see, in determining that carrying amount, they do that using a fixed asset schedule. You see, that model is done through a fixed asset schedule in the notes to the financial statement. And for cost model, that costs accumulated depreciation, accumulated impairment losses. I told you that each of them are separate ledger accounts. They are separate ledger accounts. That cost that you see there is the asset account itself. The asset account is always at what? Cost. It's not the asset account that you use in determining carrying amount. No. Asset account is not what show cost minus depreciation. No. If that's what you know before, forget that. Where you do the cost minus accumulated depreciation minus accumulated impairment losses is in your fixed asset what? Schedule. Each of those elements, the cost, is a separate ledger account, and that cost is the asset account. The accumulated depreciation account is also a separate ledger account on its own, and the accumulated impairment loss is a separate ledger account. They are separate accounts in their own right. We went into it. I started with the costs that we have already explained that already. That's the initial measurement that we did, where we got those components of cost. Then the accumulated depreciation. That was when I started explaining depreciation to you last week. And I told you that depreciation is a systematic allocation of the cost or depreciable amount of an asset over its estimated useful life. I started with the cost or depreciable amount. I told you that the cost and the depreciable amount are the same thing. The only difference will arise where there is fair value. Cost and depreciable amount are the same. Difference will arise where we have what? Sorry, when we have residual value, and residual value will come in when you deduct it from the cost. So when you deduct residual value from the cost, you get depreciable amount. That's the only difference. Otherwise, cost and depreciable amount are what? Are the same. And why are we removing residual value from the cost? I told you because we can't allocate that. Because residual value is the value of an asset at the end of its useful life. We don't use the residual value. It's like the scrap value. So we cannot allocate it to each year of the asset. We don't use it. So when we have residual value, you remove it from the cost before you then allocate whatever is remaining, which is the depreciable amount. Then we went on to the useful life. I told you that useful life is either the period over which you use an asset or the units that you produce from an asset or the number of hours for which you use an asset. That's useful life. And we also mentioned the factors that determine the useful life of an asset, from the level of usage to maintenance culture to a contract that places legal limit on that asset to what again? To the quality of the asset, and all of those determines the useful life of an asset. And I told you that useful life is an estimate. It's not a value that you can determine with precision. You can only estimate it. So IAS 16 allows that at the end of every year, you can revise it. You can change it. It's allowed because it's an estimate anyways. Then finally, which was where we stopped last week, we looked at the systematic allocation, which is the depreciable method. And I told you that there are two depreciation methods. We have straight line method and we have reducing balance method. And that is where I'm going to stop. I'm going to start today. So today our target is to continue with the principles. Then we'll start solving questions today. So today I will quickly run through the principle for these depreciation methods. Then I will explain revaluation. Then I will explain disposal. When I explain those principles, then we can start solving questions. Then anywhere we stop before 7:15, then we can go. Now, let me start from that depreciation methods. And don't forget, I made an emphasis last week on depreciation. That depreciation is not reduction in the value of an asset. Depreciation is not wear and tear of an asset. Depreciation is just allocation of the cost. Depreciation is just complying with matching and accrual concept. That, okay, we have used an asset this year. Then how much should we put in P&L as an expense relating to this asset this year? Or this asset has made money for us this year. What expense should we match with that revenue? So it's just the portion of the cost of an asset that relates to this year. That's depreciation. Depreciation is not reduction in value. No. Even assets that are appreciating in value, you depreciate. So that word depreciation is not synonymous to reduction or wear and tear. No. It's just an accounting term to show how we allocate that cost to each year of the asset's life. So now, the method of allocating that cost, we said there is straight line method. And we said there is what? You see this straight line method? This method would give you equal amount of depreciation every year. It will give you the same amount of depreciation every year. And you can only use this method if you can estimate that your asset generates equal amount of benefits every year. Then you can use straight line. So if your asset generates equal amount of benefit every year, then it makes sense to allocate that cost to equally every year. That's when you do straight line method. But you see this reducing balance method, this one will give you higher amount of depreciation at the earlier years of the assets and lower at the later years of the asset. And this is also the same, that you use this method where your asset generates higher benefits at its earlier years and lower benefits at its later years. That is when you use reducing balance method. So the way you achieve this for straight line method, the way this gives you equal amount of benefit every year is that your depreciation per annum will be the cost minus the what? The residual value all upon the what? Estimated what? All upon the estimated useful life. What is this cost minus residual value? What is it called? Depreciable amount. So when you divide it by the useful life, whatever you get is the depreciation every year. It will definitely give you the same amount of depreciation every year. The same. Or you can simply do depreciation rates multiplied by the costs or the depreciable amount if you have residual value. Either ways, you should get the same thing. Doing this will give you equal amount of depreciation every year. Year in, year out, you have equal amount of what? Of depreciation. Then, for the reducing balance method, for this, your depreciation per annum is your depreciation rate multiplied by what? Multiplied by carrying amount. Of course, in the first year, carrying amount will be equal to the cost of the assets. So you simply use the cost in the first year. So this one will definitely give you an higher amount of depreciation at earlier years, lower amount of depreciation at later years. So reducing balance, your depreciation per annum is the depreciation rate multiplied by the what? By the carrying amount. Okay. Let's say we have this scenario. Let's say we have a trial balance. They gave us PPE, or they gave us a plant and machinery, and the cost is 250. And they told us that the accumulated depreciation is 50,000. We're now told that the useful life of the assets is 10 years. They now said calculate depreciation for the year or per annum using straight line method and what? Let's say we have a scenario like this. Using this formula, can you see if you can get the depreciation? For the reducing balance, be sure that they will give you a depreciation rate. Let's say they give us 10% depreciation rates. Using this formula, can you calculate the depreciation using straight line and the depreciation using reducing balance? Please do. I want you to do it. I'm allowing you like 2 minutes for that. Anybody? How much? Using straight line. What about reducing balance? Straight line is 20,000. Reducing balance is 25,000. Okay, let's check. So using straight line, my depreciation per annum is the cost minus what? Minus residual value over what? Estimated useful life. What's the cost given to us in this question? What's the residual value? 0. What's the useful life? What's depreciation per annum? So if you say 25,000, you are correct. If you say otherwise, you are not correct. Using reducing balance method, the depreciation per annum is the depreciation rate multiplied by what? Carrying amount. And what's the depreciation rate? What's my carrying amount? 250 minus what? Accumulated depreciation, 50,000. And that gives me how much? 20,000. Okay. That's the major difference between the two. Right? And I can also calculate using straight line using the rate too. It should give me the same thing. If I use the rate to calculate my depreciation here, it's just 10% multiplied by the what? By the cost. Just like I gave you here. Which is how much? 25,000. Now look up, please. You can write it, but we are going to solve plenty of questions here. The whole of next class is dedicated to solving, yes, the entirety of that next class. But we'll solve few questions today, like 2 or so. The next thing is, you see, when you have depreciation, is an end of the year entry. It's something, it's like an adjustment to the account. It's something you do at the end of the year. So to put it in your books, usually pass journal. Okay? So you see the journal entry, first, you debit P&L with, you call it depreciation expense. Usually, you see companies adding it as part of their administrative expenses in P&L. Or in some organizations, if the amount is material, they will put it as a separate line item on the face of the P&L. They will call it depreciation and amortization. They can do that if the amount is material. The same way, personnel cost. While mostly we include it as part of admin, when you check some accounts, you see they will put it as a separate line item because mostly it's always very material. So they put it separately on the face of the account. Do you know what we credit? What do we credit? Yes, we have debited depreciation account. Not asset, far from it. I've told you, and don't ever make that mistake again. Otherwise, you'll be in trouble. Depreciation has nothing to do with asset account. I've told you what is in the asset account is always at cost. Don't ever make that mistake again in this class. Depreciation is a separate account on its own. So what you credit is an account called what? Accumulated depreciation account. It's a separate account on its own. You see, this one that you debited, it goes to P&L every year. It goes there to P&L. But you see this accumulated depreciation account, it's not, some people call it provision for depreciation. No, no. It's not a provision. It's far from it. It's an account called accumulated depreciation. Usually it will be in your general ledger, and its aim in life, it has only one aim in life. It's just for it to help you determine your carrying amount. And the way it does that is through that cost model in your fixed asset schedule. That is his aim in life. It's not more than that. So, and you see, this guy, accumulated depreciation, the balance is always carried forward every year. Is cumulative. That's why they call it accumulated depreciation. His aim is just to help you determine your carrying amount every year. Every year. So from your GL, it goes to the trial balance. From the trial balance, it doesn't go to the statements. No. From there, it goes to the fixed asset schedule in the notes to help you determine your what? Carry. That's his aim in life. So in this instance now, like using straight line, for example, where we got depreciation as 25,000, what will be our carrying amount? What will be our carrying amount? What's the cost? What's the accumulated depreciation? Thank you. The brought forward is how much? Then depreciation for the year is how much? That means the total accumulated is now how much? What's my carrying amount? How is this guy aim in life? To help you determine your carrying amount. And this is double M. Please don't forget, it has nothing to do with the asset account at all. Asset account is just at cost always. It's at cost always. So that's the end of depreciation. That's the principle. We'll still solve plenty questions on it.
At the end of the useful life of some asset, that accumulated depreciation, what is the example? Right.
So she said that at the end of the useful life of the asset, what happens to the accumulated depreciation account? What happens to it? It's going to nil because it will make your carrying amount of the asset to be zero. Okay, so as soon as we take it to 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 the fixed asset schedule at the end of the useful life of the asset, that's the end for it. That's the end for it usually. So as soon as it's the end, because your carrying amount at the end of the life of the asset, we expect it to be zero. So it's just going to equal the cost of the asset. No, you cannot revalue it again. So at the end of the useful life of an asset, you cannot revalue the asset again. So I mean, she's looking at a scenario whereby you are still using the assets, right? But at the end of its useful life, the carrying amount is now zero, but the asset is still active. What would you do in that scenario? Yes, now. Why won't it be possible? In fact, that's always the case in most instances. You find companies, they are fully allocated the depreciation, but they are still using the asset. No, you cannot revalue the asset. You cannot jump from cost model to revaluation model. Okay, if you are using cost model, you would have to continue. If you are using evaluation model, that's what you have to do. That's not what you do. In fact, it's a mistake. I told you that at the end of every year, you are supposed to be revising the useful life of the asset. Anytime we go out for audit, it's always an headache for us because it's now too late. What you are supposed to do is to extend the useful life. And that should have been done earlier on. Should have been done earlier. You should not have waited until the carrying amount is not zero. That one, you cannot revise anything anymore. Exactly. So what you should have done, in fact, what the standard said, which I've mentioned to you, is that at the end of every year, you need to be reassessing the useful life. That does it make sense? Does it make sense? And I said that you said you gave it 4 years useful life. At the end of the second year, you see that the asset can still go another 5 years. Extend. Extend. So you're supposed to be extending so that you will not find yourself in a situation whereby carrying amount is not zero. Or the asset is at the end of its useful life, but you are still using the asset. Yes, that's what the standard said. In fact, you're supposed to be doing that every year. You're supposed to be reassessing the useful life every year. There won't be that situation. There won't be. Because you'll be reassessing it. You'll be reassessing it. Until when you see that, okay, this asset is over, you don't need to reassess it anymore. Eh? Everything works out.
So that's why we are here to upgrade and update. Still on the definition of
Continue, sir.
depreciation. That is no longer reducing value, it's no longer wear and tear. Ah. Sincerely, I still told my students about 2 weeks ago that depreciation is the reduction in
Reduction.
value. So conscience. Now, when you look at an asset, sincerely, asset doesn't mean every day in day out as day passes by. At the same time, when I buy this, my phone, I just bought it in November, December.
Mm-hmm.
I can never sell it to the same amount I bought it.
Yes.
How come is depreciation not a reducing?
Exactly. Yeah. I mean, it's definitely not okay, and it's clear in the standard based on the definition. And another thing you need to understand is accountants. Our work is recording and presentation of transaction. We are not trained as a valuer. We are not trained to measure wear and tear. So depreciation can never be wear and tear. That is not accounting. Accounting is far from that. Okay? Accounting is based on accrual basis, and that's what we are trying to do with depreciation. That we have bought an asset that's supposed to be useful for 5 years. At the every year we are using it, and how much have we used? So you expense that portion. That is what depreciation is all about. So we are not supposed to measure the reduction in value. No, it's far. There won't be any scenario where in any standard that you will hear me teach you that. Our own is recognition and measurement. Okay, and we have our measurement basis, historical cost and current value. That's what we do. We don't do wear and tear. So it's really far from it. And considering the fact that the asset becoming old, yes, it's okay. Can become old as a result of usage. That's fine. We don't measure. I mean, we are also using it. We are making money from it. That's why we are recognizing cost every year. Okay, so we are not capturing that reduction in value. We are capturing the costs, the expense every year. That's what accountants do. That's what we want so that we can know what our profit is. Okay? So that we can know what our profit is. And that's why carrying amount also, if you look at it sincerely, is reflecting that oldness of the asset. Is Okay, now, revaluation. Now, this revaluation is arising or will arise when a company uses revaluation model. Okay, and don't forget that revaluation model. I told you that revaluation model is the fair value. We can also call it revalued amounts minus what? Subsequent accumulated depreciation minus what? No, there is no subsequent in the impairment losses. Yes, accumulated impairment losses. That gives you what? Fair value or carrying amount. Now, the one I want to deal with first is this one. This revaluation. When I'm done with that, I go to subsequent accumulated depreciation because this one is different from that one of cost model. Because for cost model, there is no subsequent there. It's just accumulated depreciation. So we need to clarify the two. So pay maximum attention to this. Again, I need to re-emphasize that the aim of this revaluation model in life is to determine this carrying amount. And it's usually done through fixed asset schedule. That has to be clear. Secondly, each of these items in this formula, they are separate ledger accounts. The one that is asset account is this one. If you are using revaluation model, your asset account will always reflect fair value. Your asset account will always reflect what? Fair value. If you are using cost model, your asset account will always reflect costs of that asset. So this is the asset account. And you see, when you're using evaluation model, it simply means that you need to be revaluing your asset. You need to be marking it to market, either through getting the fair value or the current cost, depending on why you are doing the revaluation. If you are doing the revaluation to sell the assets, then fair value. If you are doing the revaluation to know what's the value today, current cost. Okay? Now, you see, when you do this revaluation, it usually results in changes in value. The way you have left it last year is not how you meet it anymore. There will be change. So our focus today is how do you then account for this what? This change. I'll give you 3 scenarios. So scenario 1, if you have your asset account, which would be at fair value, let's say at the beginning of the year, let's say it was, yeah. Okay, let's continue, please. So if you have an asset account, which at the beginning was at 120,000, the fair value of our asset, we now revalued it. We now got a new valuation, like a new fair value. We now got a new fair value. Let's say we got 150,000. This simply means that our asset account needs to be updated. Abi, it should not show 120,000 anymore. But what should it be showing? 150,000. And to do that, to update our asset account, in accounting, we don't clean. We will not rub it and change it to. What would you do? You pass a journal. Abi? So to increase the value of your asset, you increase it by how much? 30,000. So are you going to debit the asset account or are you going to credit it? Debit the asset. So to increase the asset account, you debit the asset account by how much? That would automatically increase it from 120 to what? 150. What do you credit? Okay, evaluation or evaluation. But where does it go? Yes. Goes to where? OCI. Thank you very much. So this amount, Afonja, like you rightly said, is a revaluation surplus. Okay, that's the account you credit, but it goes to where? OCI. Do you know what OCI means? Other comprehensive income. Please, if you have not learned that template that I taught you in this week 2, no, week 3, please go and learn it very well. I already told you what OCI, other comprehensive income. So you need to be reading, especially this my own part. It's a build-up of knowledge. Everything is sequential. So you simply credit what? Other comprehensive income. And do you know why we are crediting those? Because this is an income. It's an income. Why is it going to OCI and not P&L? It's not our core business. That is wrong. Yes, that is what it is. But why is it going to P&L, OCI and not P&L? It is gain on evaluation, yes. No, that is not why it's going to OCI. It's not because he wants to increase equity. It is an income. No, if it doesn't, what do you mean by it doesn't follow the normal business operation? The reason I told you is because it's an unearned income. We have not earned it. It's not because it's not our core area of operation. Even if it is not your core area of operation and you make income from other things, it goes to other income in P&L. It goes to other income. But income that goes to OCI are income that arise from changes in the value of an asset. This type of income are unrealized. They are not income you can say you want to distribute as dividend. It's just changes in value. What happens is if the value tumbles. So don't take such income to P&L. Take them to where? OCI. That is why we credit this guy to OCI. And that's the double entry for this. That's scenario 1. Any questions? No questions. Scenario 2. Let's say we have an asset account whose value was 150,000 and we have our new valuation, which is now the new fair value of the asset. We have it as 170. And in the previous year, there was a revaluation deficit. That is last year. There was a revaluation deficit on that asset last year of 5,000. So how do you deal with this? In our asset account, at the beginning, the fair value was 150. We did a revaluation at the end of the year, 170. But in the previous year, when we had a revaluation, we had a deficit last year of 5,000. So how do we deal with this? Firstly, is that our revaluation surplus here is how much? It's 20,000. It's 20,000. and which is revaluation surplus because the value went up by 20,000. Abi, this 20,000, we're going to debit our assets with the how much? With the 20,000 to increase the value of our asset from 150 to 170. Unlike this one where we credited the entire surplus to OCI, in this case we cannot, because on the same assets we had a previous devaluation deficit. It has to be on the same asset. If it's on another asset, it cannot work. This explanation will not work. It has to be on the same what? Asset. On the same asset, we had a deficit that we took to P&L because deficit will have gone to P&L last year. In that wise, that means we cannot take the entire 20,000 to OCI, but rather we will first of all take 5,000 to PRL. We will first of all take how much to PRL? 5,000 as a debit, not even the debit, as a credit to net off that last deficit. We need to net it off first. Is any excess, because we're going to net it off to the extent of that deficit. 5,000. So how much surplus is remaining? Then we can then credit the remaining to where? OCI. That goes to show that yes, when you have surplus, it should go to OCI, but it can also go to P&L if there was a previous what? Deficit on that same asset. You need to first of all net off that deficit to the extent of that deficit. To the what? To the extent of that deficit. That's why a limited one went to P&L to how much? 5,000. Excess now went to what? OCI. Now, you see, I would not write this. I will just explain this next one. If, for example, our asset account were to be, let's say, 150,000. Okay? We now did a revaluation. Are you with me?
Yes.
You now did a revaluation. It's now 120. That means instead of surplus, we are having a what? A deficit. With that deficit, that means you need to bring down the value of your assets. What do you do to that asset account? You credit it. What do you debit? POL. Deficit goes to POL directly because they are losses. Deficit is a loss. So it's definitely going to be recognized to where? POL. So that is how deficit works. Let's go to scenario 3. If you have an asset account with a value of 175,000 and we now did a new valuation or the fair value is now 161, or let me make it a round figure so it's easy to compute, 160. But last year we had a revaluation surplus last year of 7,000. So how do we deal with this? How do we deal with this? In this case first, you will see that in this year, the value of our assets has gone south, right? It has gone down. That means we are having a revaluation deficit of how much? of 15,000. But unlike the hypothetical example that I didn't write on the board, where we took the entire deficit to P&L, in this case, in previous year on the same asset, we had a surplus of 7,000 on the same asset. That means that we have to go and net off that surplus in OCI first before we take any excess to P&L, which goes to show that with this 15,000, we are going to credit our assets with how much? 15,000. We are going to debit OCI with how much? To the extent of that surplus. Then whatever excess will go to where? Which is how much? Which will be how much? 8,000. To the extent. So, since we're having a previous surplus last year, you cannot take the entire 15,000 as a debit to P&L. Everything cannot go there. We have to net off that previous surplus first. So that surplus that we had last year of 7,000, it will be a credit entry. So to net it off, what do? We pass a debit to OCI, or to the extent of that surplus, which is 7,000. Then any excess can then go to where? P&L as a deficit of how much? Of 8,000. Any excess. This 8,000 is simply 15 minus what? 7,000. Final scenario. If you understand this one, that is all. I'm done with revaluation. Scenario 4. If our asset account was carrying 205,000 and the accumulated depreciation account is carrying 45,000. We now did a new valuation where we got fair value, and let's say that fair value is now 190,000, and there was a revaluation deficit last year of 11,000. If you understand this one, that is everything. It is no more than that. If you understand this, you're done. You're fine. So, let's see how it works. How do we deal with this? So, the first thing we need to establish is that, are we having a surplus or a deficit? That's the first thing we need to establish. Are we having a surplus or deficit? Who can tell me? Of how much? The deficit of how much? 15,000. Of how much? 15,000. That's wrong. Now, the other scenarios, the only reason why it was so straightforward is because I have not introduced accumulated depreciation. You see, revaluation surplus or deficit is determined by comparing carrying amount at the beginning against the new value. Not cost against the new value. No, it's because in the previous one we never had depreciation. When you have depreciation, then you can determine carrying amount. Don't ever forget this. That's extremely important. In fact, that's the most, because in your exam, they hardly ask all these debit, credits, all of this. They hardly, I'm just teaching you this to be detailed. In your exam is always very straightforward. Very straightforward. So they will just give you carrying amount. They will give you costs. They will give you accumulated depreciation. They will give you new value. They will say, yeah, that's all. 3 marks, 2 marks, like that. So always remember that your revaluation surplus or deficit is determined by comparing carrying amount against the what? The new value. So the carrying amount here is the cost. How much is the cost? Accumulated depreciation, how much is it? Giving me how much? Then my new value, how much? Is it a surplus or a deficit? Of how much? Who can do the double entry for this? Please do it. What's the journal for this? You debit assets. Okay, with how much? 30,000. Fantastic. What do you do again? You debit assets with what? Let me not take that, your own is too far away. Let's get 160,000. Eh? Where did you see one? Oh, okay, this is 160. Okay, I think she is more like it. You said you debit assets with how much? 30,000, yes. Credit P&L with how much? Because there was a previous deficit, Abi. And what do you do? Credit OCI with how much? 19,000. Wrong. Wrong. Do you know why you're wrong? There are many reasons, right? I'll just give you the obvious one. When you debit asset with 30,000, that means you are increasing your assets from 205 to 235,000. That's wrong. Where we want our asset to be is what? So let me help you clean it. So you can't debit the asset. So the first thing you need to establish, which is always straightforward, is get the revaluation surplus or deficit. And the principle for that one is clear. Compare carrying amount against the new value. Get that first. You see, when you have established that, the next immediate thing to do is that, no, you want to ask question, you ask me, so that you will not mix and underline yourself. The next thing after getting this one is for you to update the value of your asset. Where do you want your asset to be? That means you want to reduce it from 205 to how much? So when you want to decrease the value of your asset, what do? You need to determine that. That means you credit your asset with how much? How much? How much? What's the difference now? Why are you not saying 30,000 again? With 15,000. Okay, when you credit your asset with 15,000, it falls from 205 to what? To 190. When you have established that, the other ones are they will just fall in place. Then you can then use your other knowledge that yes, we had a surplus of 30,000. You should go to OCI, Abi, but you cannot go to OCI because there was a previous what? Deficit. Then that one we can debit it to where? POL with 11,000. Abi, then whatever is remaining, no debit bow. You credit P&L with what? 11,000 to net off this what? Deficit. We need to net it off. Then whatever is remaining, where do you take it to? You credit OCI with how much? 19,000. All of them are what? I mean, we have not done anything wrong. It's not will be to balance. Credit, credit, credit. So let's see what is happening. We have credited this with 15,000, Abi, to bring our asset down from 205 to 190. Abi? Then, ordinarily, our surplus, we should just credit OCI, but we cannot because there was a previous deficit. That was why we split first 11,000 to net off that deficit. That was why we credited P&L. Whatever that is the balance can then go and settle in where? OCI. So there's still one thing that is remaining, because if you add this one, this plus this gives you how much? So there's something we still need to debit, that is 45,000. Accumulated depreciation. You need to debit it. You need to debit it because this is a revaluation. And you will see that pay attention, madam. If you want to ask question, you ask me. Otherwise, you will distract him himself. So you need to debit this one because this is revaluation. And when you revalue an asset, any depreciation you have charged to date must be eliminated. It must be cancelled out. And that is why this accumulated depreciation is debited to clean out the depreciation account, the accumulated depreciation account. And that is why revaluation model is fair value minus subsequent accumulated depreciation, meaning that we would have cancelled out the earlier accumulated depreciation. When you revalue an asset, it's like you are starting over from the beginning. Any depreciation to date must be what? Must be cancelled out. Then you now start over. You now start over from the new value, which is this. So at the end of the year now, you now need to calculate a new depreciation. So to now get our carrying amount for that year, to now be this fair value minus subsequent accumulated depreciation. Because the previous depreciation will have been what? Will have been cancelled out entirely. That is revaluation for you. It's like everything is starting all over again. In fact, the useful life sometimes, they will revise it. That will also begin. It's like a new beginning for the asset. I mean, if you can understand this, it doesn't go beyond this. I can promise you that. This is the extent to which it gets to, and this is the right way to learn revaluation. So the first thing we established that you need to always get right is to determine the revaluation surplus or deficits, which is determined by comparing the carrying amount with the what? With the fair value. Not the cost with the fair value, no. It's the carrying amount with the what? Fair value. That is the first thing you need to never get wrong. Secondly, is to understand that the asset needs to be updated to its new value. The asset needs to be what? Updated to it, because what the asset has to reflect is this new value. So don't just automatically think this surplus must be what goes to the asset account. No. You always compare what is the asset account before against the new. That's what you take. So in this case now, it's going south. We need to credit that asset to bring it down by 15. Ordinarily, we should just credit OCI by 30. Yes. But because there was a previous deficit last year, that was why a portion went to where? Here. Then the balance can then go to where? OCI. When that is settled, the balancing figure, I can promise you, will always be equal to this accumulated depreciation. I can promise you that. What will make this thing balance? It will be the accumulated depreciation. So the accumulated depreciation cancellation is not the problem, because that is what will make it equal. But what you need to get right is your asset account. Do the simple logic. Then deal with the revaluation. Okay? I mean, I intentionally did this extreme one for you. Because ordinarily, in a question like this, they might not give you past revaluation deficits. So that one is a bit straightforward. This 30,000 will just go to where? OCI. So it will still be 45,000. 15, 30. I mean, then the balancing is a debit that goes to accumulated depreciation, 45. But here, because there was a previous deficit, we need to split it. We need to net off that deficit first. It goes to P&L. Then the remaining went to OCI. This will balance it up. Debiting accumulated depreciation. You know this, you have that's everything on the value. It's not more than this. Everything. If you understand all these scenarios, you are good to go. Yeah. Oh, if you want to know how we got this 19,000. So 19,000, this is the surplus, 30,000. And the 11,000 is the previous deficit. Any excess above this 11,000, which is 30 minus 11,000, goes to OCI. It's just like the remaining out of this 30,000 goes to OCI. That's how we got this 19,000. The excess. Just like I've done in previous ones also, is the excess. Where did I do it before? I did it here. Where you had a surplus of 20,000. We did not take the entire 20,000 to OCI because there was a previous deficit. So we took 5,000 to P&L. The excess can then go to OCI, which is 20 minus 5. The same principle, the same thing. It's a build-up of knowledge. Questions? We are done with revaluation. OCI means other comprehensive income. Other comprehensive income. Please, those that are coming newly, we have abundance of resources for you. We have videos for you. This class is recorded. So, I mean, you can attend this class after this class. It's the same. And the same thing applies to all my previous classes. All are recorded. This note you have is very detailed. We have done 3 topics so far. Regulatory framework, recorded. Conceptual framework, same. Presentation, you need to go and, before you come to next class, go and study that presentation. That one is important. Because you need to be used to that. Then now, IAS 16. And I'm already going far. What you have learned is not small. If only you know the value of what you have learned today. Maybe you need to calm down. You need to calm down. After, like, when I can tell you that when you write the exam, you will pass, it's week 10. Yeah, at week 10, I can tell you if you go and write the exam, you will pass. At week 10. If you have read everything I've taught you and with what Mr. Ibrahim will have taught you to date, you can pass. So week 11 to week is just excess. So ideally, none of our students should fail, which is mostly should be the instance. I mean, that's if you read all of these things and if you understand it. If you don't read and understand it, there's no magic. You see passing. Okay, we are done with evaluation. Now, the last principle, disposal. The last principle, disposal. Yes, ma'am. Oh, okay. Disposal. Disposal. Okay. So, what's the principle around this? The first thing we need to establish is that disposal will arise when you derecognize an asset. Okay? So it can arise as a result of what? Derecognition. That is where you can have disposal. Derecognition. And do you know what derecognition means? What does it mean according to the conceptual framework? Removal or exclusion. Yeah. Remove the asset from our books. Okay? And one of the ways is through what? Disposal. So when you dispose or sell an asset, it will usually result in either you are making a profit or a gain or a loss on disposal, which is what I can often ask you. That whenever you dispose, the one thing you need to always calculate, which I will show you in most of questions we will solve, is you are going to get a gain or a loss on what? Disposal. And how do you get that? Is by comparing the carrying amount of the asset with the what? With the sales proceeds of the asset. The difference gives you gain or loss on disposal. So let's assume this is in jackets, which is usually the case. So if it's a gain, this will be positive. If it's a loss, this will be negative. So gain or loss on disposal. If it's a gain on disposal, which statement will it go? Is it OCI or P&L? OCI or P or L? OCI, right? If it's a gain, goes to where? It's P&L. Why will it go to OCI? You sold something. You have made your money now. You have earned it now. Something you have sold. You have made your money. In fact, it is at that point, Seth, that you earn that revaluation surplus. That revaluation surplus that was in OCI. As soon as you sell that asset, it becomes earned. In fact, you will take it from OCI, you will go and dump it in retained earnings. Because it has become what? Earned. Okay? So this gain goes to POL as other income. While loss on disposal, you can put it as part of your administrative expenses. Can come in as part of your admin expense. Loss on disposal. You see, this is what ICANN cares about. Whenever they tell you they sold an asset, just know, remember that your carrying amount is cost minus accumulated depreciation. Abi? Then compare that with the sales proceeds. Know where this one go to. That's all. But it's beyond this, really. It's beyond this. Because how do you close all of those accounts? Now that you have sold the asset. I've not seen ICANN exam asking you to close all of these accounts, but you need to know how to close it as a financial reporting student. Your ICANN exam is always very easy, but let me show you how to close it. Let me show you how to close it. Let me show you how to close it. I've not really seen them ask this. I don't know why, but let me show you. You see, when you sell an asset, all the accounts related to that asset must be closed out. And the very first account is the asset account itself. You need to close it out. You need to cancel it out. And how do you do that? You credit it. Thank you very much, because it's a debit account. What do you debit? Thank you very much. Not P&L, far from it. Disposal account is a temporary account. You used to close out this process. You want to use it to clean it out. Take it to disposal account. You can never go to P&L. Otherwise, you want to cause trouble to expense. So it goes to a disposal account. And with what? With what value? With what? Carrying amount. Why? I don't know how many times I want to tell you that your asset account is always at cost or fair value depending on which model you are using. So I don't know why you are saying carrying amount. So this asset account is always at cost if you are using cost model. It's always at fair value if you are using evaluation model. Okay? So that's that. The next account you need to close out is the accumulated depreciation account. We need to close it out as well. And to close it out, what do we do? It's always a credit, so you debit it. Abi? Accumulated depreciation. What do we credit? Disposal account with carrying amount báwo now? With the accumulated depreciation of the assets. So you will see that at this point, your disposal account would look like this. Your disposal account will look like this at this point. Your disposal account will look like this at this point because you have taken the cost of the assets to where? To the debit of the disposal account. Abi? Let's say this is 100,000. The accumulated depreciation, you have taken it to the credit side of the disposal account. Let's say this is 70,000. That means your disposal account will be having a balance of how much? Which is carrying amount. Abi? Then finally, with this, you have closed out everything that have to do with that asset from your books. Everything. The only thing that is left is the money you now received when you sold the asset. You're going to debit what? Bank. You know, it's possible that you sold an asset, you now collected another asset. You know, it's possible. So, the money you received, you debit bank. Why if it wasn't money? That it was another asset you collected. You debit what? In fact, the new asset. What do you credit? Disposal what? With the sales proceeds or the trading value of the assets, like the value of the new asset, trading value of the asset. So that's as good as saying sales proceeds here. Let's say this is 50,000. In this case now, you'll be making a gain. You're making how much? Because the carrying amount is how much? Is 30. How much did you collect to sell? 50. You are making a gain of how much? 20. But the only where you usually use this is when we are teaching you cash flow statement. In most scenarios that you will see me solving in published accounts and all of that, you will see that this one is just enough for you. But please, my dear students, learn this. You need to learn this as well. So, I'm going to stop here for today.